Okay, so let's dive into the world of Warren Buffett.
Sounds good.
Today,
Oh, yeah.
we're exploring his unique approach to business and investing as detailed in
Sure.
the Essays of Warren Buffett. Lessons for Corporate America.
Right.
Think of it as like a cheat sheet to understanding how
Yeah,
one of the greatest investors of all time built his empire.
exactly. We're not just talking about picking stocks, though.
Right.
These essays reveal the principles behind building successful businesses,
Hmm.
managing them effectively, and fostering a strong corporate culture.
You know, whenever I hear about Berkshire Hathaway,
Yeah.
I picture this massive, complicated corporation.
Right.
But really, it's more like a carefully curated collection of businesses, isn't it?
Exactly. It's not just a random assortment either.
Right.
Buffett and his partner Charlie Munger,
Yeah.
they have a specific method they call the double-barreled approach.
I like it.
So first, they seek out undervalued companies with strong leaders already in place. And second, they trust those leaders to run their businesses independently.
That second part is fascinating to me.
Yeah,
You know, it takes a lot of faith to step back and let someone else take the reins.
it does.
So what does Buffett look for in those strong managers? What are the signs of a leader
Mhm.
that he would trust to build value?
He's looking for more than just a good track record.
Okay.
It's about character and competence, a deep understanding of the business and a passion for what they do.
Right.
Think of it as finding someone who treats the business as if it were their own.
Yeah, that makes sense. Now, this double-barreled approach has led to some pretty impressive results, hasn't it?
It has.
I mean, a 23.8% compounded annual growth in book value per share is nothing to sneeze at.
It's incredible.
Wow.
Yeah, it's a testament to the power of long-term thinking and a focus on intrinsic value.
Mm-hmm.
And that brings us to another key aspect of Buffett's philosophy.
Okay.
He sees Berkshire as a partnership between himself, Charlie Munger, and all the other shareholders.
Okay, so it's not just about making himself rich.
No,
It's about growing the pie for everyone
not
involved.
everyone, yeah.
That's a refreshing perspective in the world of high finance, wouldn't you say?
Absolutely. And this partnership mentality permeates everything they do, from the way they communicate with shareholders to the way they run their businesses.
Yeah.
Take their annual shareholder meetings, for example.
Oh, yeah. I've heard these meetings are legendary,
Oh, they are?
with thousands of people flocking to Omaha to hear Buffett and Munger
It's true.
answer questions.
Yeah.
That's not your typical dry corporate event.
No, not at all.
I bet.
It's a testament to their commitment to transparency and genuine engagement. They're not afraid to answer tough questions and share their insights openly.
Yeah. Speaking of insights, there's a funny story about a corporate jet
Oh, yes.
that perfectly illustrates
Yes.
how Buffett and Munger make decisions.
The infamous indefensible, as they named it.
Tell me everything.
Initially, both Buffett and Munger were opposed to buying a corporate jet.
Okay.
They saw it as an unnecessary luxury.
Right.
But as Berkshire grew, they realized that having a jet could actually save time and improve efficiency, ultimately benefiting the partnership.
Okay, so they were willing to change their minds based on new information
Absolutely.
and a deeper understanding of the situation.
Exactly. And they even kept the ironic name, the indefensible,
I love that.
as a reminder to constantly reevaluate their decisions and stay grounded.
It's a good reminder for everybody, right?
It is. It is.
Because, yeah, how often do we cling to our initial opinions,
Right.
even when new information suggests we might be wrong?
Yeah.
I know I'm guilty of that sometimes.
We all are.
Yeah.
Yeah, it's a human tendency.
Right.
But successful leaders, like Buffett,
Mm-hmm.
they're able to recognize when it's time to adapt and change course.
Speaking of leaders,
Yeah.
Buffett has a very particular way of selecting CEOs.
He does.
He's not swayed by fancy resumes or short-term performance metrics.
Nope.
He's looking for something much deeper. Capability and integrity.
Those are the key ingredients.
Those are the foundational qualities he believes are essential for long-term success.
Absolutely.
So it's more about character and competence than anything else.
It really is.
But how do you accurately assess those qualities?
Right.
Especially when you're dealing with someone you might not know very well.
It's a challenge.
Yeah.
And Buffett acknowledges there are no easy answers.
Okay.
He highlights 3 major difficulties in evaluating CEOs, especially in the short term.
All right. What are those?
So first,
Yeah.
it's often hard to isolate a CEO's true impact from external factors that can influence a company's performance.
Okay. That makes sense.
The second is that boards can sometimes create problems through their structure or dynamics, making it difficult for CEOs to succeed even if they are capable.
Right, so it's not all on the CEO.
No, not at all.
A lot of
There are
factors at play.
other things going on. Yeah. And finally, judging performance based on short-term results can be misleading,
Right.
as the true impact of a CEO's decisions may not be apparent for years.
So you really have to take the long view
You do.
when you're looking at those kinds of things.
Exactly.
Okay, so it's not just about finding a brilliant strategist.
No.
It's about finding someone who aligns with your values,
Right.
who you can trust to make sound decisions, even when faced with pressure or uncertainty.
That's it.
And it should be as straightforward as hiring an office manager, according to Buffett.
He says that, yeah.
Find someone you believe in, someone who's capable and honest,
Yes.
and then give them the space to do their job.
That's the key.
That sounds simple in theory,
Yeah.
but I imagine it's a lot harder in practice.
It can be.
What qualities do you think are most important in a leader?
Well, integrity and competence are certainly high on the list, as Buffett suggests. But I also think vision, the ability to inspire others, and a willingness to learn and adapt are crucial for navigating today's complex business world.
Totally agree. Now let's talk about risk,
Okay.
a topic that often gets oversimplified in the investment world.
It does.
So to understand Buffett's perspective, we need to introduce a rather colorful character, Mr. Market.
Ah, yes, Mr. Market,
Have you met him?
a fictional character created by Buffett's mentor, Benjamin Graham.
Okay.
He is the personification of the stock market,
All right.
and he's a bit manic-depressive.
Manic-depressive. That sounds a little intense for a stock market analogy.
Well, Mr. Market is constantly offering to buy or sell stocks at prices that may or may not reflect their true worth.
Okay.
Some days he's euphoric, driving prices up to irrational levels.
Oh, yeah, I've seen that.
And other days he's gloomy, sending prices plummeting for no apparent reason.
You know, that actually sounds a lot like the real stock market.
It does, doesn't it?
I've definitely felt that pressure to buy or sell based on those wild swings. Have you ever fallen prey to Mr. Market's mood swings?
I think everyone who's ever invested has felt that pressure at some point.
Right.
It's a natural human reaction to get caught up in the excitement or fear of the moment.
Yeah.
But as Buffett would say, we need to focus on the fundamentals of the businesses we invest in,
Right.
not the whims of Mr. Market.
Not the whims, exactly.
Yeah.
Which brings us to another crucial concept.
Okay.
Buffett's rejection of beta as the sole measure of risk.
Ah, yes, beta.
Now, for our listeners who might not be familiar with Wall Street jargon, can you explain what beta means and why Buffett isn't a fan?
So in finance, beta measures a stock's volatility relative to the market.
Okay.
A high beta means the stock tends to swing more wildly than the overall market,
Got it.
while a low beta suggests it's more stable.
Okay.
But Buffett argues that judging risks solely on price volatility is like judging a pet's riskiness
Okay.
based on how much its price fluctuates at the pet store.
That's a brilliant analogy. It makes it so clear that volatility doesn't always equal risk.
Exactly. What really matters is understanding the underlying business, its competitive advantages,
Okay.
and its ability to generate cash flow over the long term.
So does this mean we shouldn't care about diversification?
Well, it depends.
All right.
Diversification can be important, especially if you're not confident in your ability to analyze businesses thoroughly.
Okay.
But Buffett believes that if you truly understand a business and have conviction in its long-term prospects, you don't need to spread your bets across dozens of companies.
That makes sense. Now let's get to the heart of Buffett's investment philosophy,
Okay.
value investing. But first, let's clear up what it actually means, because it's often misunderstood, wouldn't you say?
Absolutely. Value investing isn't just about finding cheap stocks.
Right.
It's about acquiring undervalued businesses with strong long-term potential.
So it's not about the price tag,
It's not just about the price tag.
but about the underlying value of the business itself.
Exactly.
But how do you determine if a business is truly undervalued? What are the signs you look for?
It's about looking beyond the current stock price
Okay.
and analyzing the company's financials, their management team, their competitive landscape, and their long-term growth prospects.
So you're essentially trying to determine what the business is truly worth,
Yes.
and then comparing that to its current market price.
Exactly.
If there's a significant gap between the two,
There you go.
that could signal an opportunity.
It could, yeah.
So you're looking for those hidden gems that the market hasn't fully recognized yet.
Precisely. And it's important to distinguish between growth investing and value investing.
Okay, so what's the difference?
Well, growth is simply one component of value.
Okay.
A truly valuable business will exhibit both growth and intrinsic value.
Mm.
And Buffett's own experience with Berkshire Hathaway early on provides a valuable lesson here.
Oh, tell me more about that.
Initially, he was drawn to Berkshire Hathaway because of its cheap stock price.
Okay.
It seemed like a bargain.
Mhm.
However, he later realized that the textile business itself was mediocre at best.
Oh, no.
He calls it a cigar butt situation.
That's cigar butt.
It's a rather colorful analogy he uses
Okay.
to describe a deeply undervalued company that might have one last puff left in it,
Okay.
one last opportunity for profit.
All right.
But the problem is that once you've extracted that last puff,
Yeah.
you're left with nothing but a worthless stub.
So even though the price was right, the underlying business wasn't actually worth investing in for the long term.
Exactly. He learned from that experience that it's far better to pay a fair price for a wonderful business
Okay.
than to snag a bargain on a mediocre one.
That's a valuable lesson.
It is.
And it leads us to another fascinating concept, the institutional imperative. It sounds a bit ominous, doesn't it?
It can be. It's the tendency for companies to blindly follow trends and make irrational decisions due to herd mentality.
So it's like peer pressure, but on a corporate level.
Exactly.
Companies doing things just because everyone else is doing them,
Yeah.
even if it doesn't make sense.
That's a great way to put it. And this can lead to all sorts of problems.
Okay.
From overpaying for acquisitions to chasing fads that quickly fade away.
Can you think of any recent examples where companies or even whole industries succumbed to this pressure?
There are plenty of examples throughout history.
Oh, yeah.
Think of the dot-com bubble in the late 90s,
Oh, right.
or the housing crisis of 2008.
Yeah.
These were situations where herd mentality and a fear of missing out led to irrational exuberance and ultimately disastrous consequences.
Yeah, that makes sense.
Yeah.
So how do we resist this institutional imperative?
Right.
How do we avoid getting caught up in the frenzy and making those same mistakes?
Buffett believes the key is to focus on long-term value creation
Okay.
and to be willing to go against the grain.
So don't let the fear of missing out or the pressure to conform drive your decisions.
Exactly.
That takes a lot of courage, though, especially when you're surrounded by people who are all doing the same thing.
It does. It does. But as Buffett has shown, it's that independent thinking and that willingness to stay true to your principles that can ultimately lead to the greatest rewards.
That's inspiring. Now let's step into the world of accounting.
All right.
Buffett is a master at seeing through the smoke and mirrors that companies sometimes use to inflate their earnings.
He is. He's particularly keen on highlighting the difference between accounting goodwill and economic goodwill.
Okay, break that down for me. What's the difference between those two types of goodwill?
Okay.
And why is it important for investors to understand?
So accounting goodwill arises from acquisitions and is amortized over time, reducing reported earnings.
Okay.
It's basically a number on a balance sheet.
Right.
But economic goodwill, the true value of a company's brand, reputation, and competitive advantage, doesn't show up on the balance sheet.
So a company could have a lot of accounting goodwill from a bunch of acquisitions.
They could.
But if those acquisitions don't actually create any real economic value, it's all just an illusion.
Exactly. And that's why Buffett urges investors to focus on owner earnings and cash flow,
Okay.
the real drivers of value, rather than getting caught up in manipulated GAAP earnings.
He has a great quote about this.
What is it?
In the long run, the market is a weighing machine.
Powerful. It's a powerful reminder that eventually the market will accurately weigh a company's true worth. The manipulations, the hype, the short-term fluctuations, they all fade away in the end. What matters is the actual value the business is generating.
It's a reassuring thought for long-term investors, isn't it?
Yeah.
It suggests that if you focus on finding those undervalued companies with strong fundamentals,
Right.
patience will eventually be rewarded.
It does. But it also underscores the importance of doing your own research and understanding the real story behind the numbers.
Yeah.
Don't just rely on what the company's telling you. Dig deeper and form your own conclusions.
Now let's talk about mergers and acquisitions.
Okay.
Buffett has a rather interesting term for these. Managerial kisses.
He does. It's a playful way of exposing the often questionable motivations behind these deals.
Okay, I'm intrigued.
Yeah.
Explain this managerial kiss concept.
Well, he compares CEOs to toad princes seeking to expand their domains.
Okay.
by acquiring managerial princesses other companies,
Got it.
even if the deal makes no economic sense.
So it's more about ego and empire building than sound business decisions.
Often, yes. And Buffett identifies 3 common board situations that can lead to these questionable acquisitions.
Okay, fill me in. What are these board situations that investors should be aware of?
So first, you have the board that acts as a rubber stamp for the CEO,
Right.
offering no real challenge or oversight.
So basically, the CEO gets to do whatever they want without any accountability.
Pretty much. The second red flag is a situation where the CEO is also the controlling shareholder, giving them immense power to push through any deal, regardless of whether it's in the best interest of the other shareholders.
That definitely sounds like a conflict of interest waiting to happen.
It often does.
Mm.
And finally, you have boards that are composed of well-intentioned but inexperienced directors.
Okay.
They might lack the financial savvy or the courage to stand up to a persuasive CEO.
So it's not enough to just have a board.
No,
It's about having a board that's independent,
independent.
experienced, and willing to challenge the CEO when necessary.
Absolutely. Buffett believes that a strong board is essential for good corporate governance and for protecting the interests of all shareholders.
Speaking of protecting shareholders,
Yes,
Buffett has some interesting views on executive compensation,
he does.
especially when it comes to stock options.
Yeah.
He's not exactly a fan of the way they're often structured, is he?
He's skeptical of how stock options can sometimes create perverse incentives,
Right.
encouraging executives to prioritize short-term stock price gains over long-term value creation.
So he sees them as potentially harmful to the company and its shareholders in the long run.
He does, particularly when they're not designed and implemented thoughtfully.
Mm-hmm.
Buffett believes that executive compensation should be aligned with the long-term interests of the company and its owners.
So it's about rewarding executives for creating real, sustainable value,
Yes,
not just for pumping up the stock price temporarily.
precisely. And Buffett walks the walk. At Berkshire Hathaway, executive compensation is relatively modest, and there's a strong emphasis on long-term performance.
It's a refreshing contrast to the often exorbitant pay packages we see in other companies.
It is.
Uh-huh.
And it speaks to Buffett's commitment to fairness and to creating a culture where everyone benefits from the company's success.
Now, before we move on, I want to touch on another area where Buffett treads cautiously.
Yeah.
Leveraged buyouts and junk bonds.
Yes, those are dangerous waters.
He sees these as danger zones,
They are?
often driven by excessive debt.
Yeah.
And fueled by Wall Street's insatiable appetite for deals.
That's right.
Okay, for those of us who aren't finance experts, can you break down what leveraged buyouts and junk bonds are and why Buffett is so wary of them?
So a leveraged buyout, or LBO,
Okay.
is basically when a company is bought using a lot of borrowed money,
Okay.
hence the term leveraged.
Makes sense.
Junk bonds are high-yield,
Mm-hmm.
high-risk bonds that are often used to finance these LBOs.
So you're essentially using debt to buy a company,
Exactly.
and then that company is saddled with a huge debt burden.
That's right.
And while leverage can magnify profits if things go well,
Right.
it can also magnify losses if things go south.
Exactly.
I can see why Buffett would be cautious. He's all about minimizing risk and maximizing long-term value.
Precisely.
Yep.
He prefers to acquire solid businesses with strong cash flows and minimal debt.
Okay.
Companies that can weather economic storms without being crushed by their debt obligations.
So it's a much more conservative approach,
It is.
but one that's proven incredibly successful over the long term.
It has. And to illustrate his patient approach to acquisitions,
Mm-hmm.
he uses a rather interesting analogy.
Okay.
The Muskie's fisherman.
All right. You've got my attention. What's a Muskie's fisherman?
A muskellunge,
Okay.
or muskie as they're often called,
Right.
is a large, elusive, and powerful freshwater fish.
Okay.
They're notoriously difficult to catch.
Got it.
And a skilled muskie fisherman has to be patient, persistent, and willing to wait for the right opportunity.
So Buffett's not out there chasing every deal that comes along.
Nope.
He's waiting for that perfect muskie to swim by.
Yeah.
A company that meets his strict criteria and offers a high probability of long-term success.
That's a great way to put it. He's not interested in making a quick buck or chasing the latest fad.
Right.
He's looking for those rare, exceptional businesses that can compound in value for decades to come.
That's a powerful image.
It is.
And it highlights the importance of discipline and patience in investing.
It does. And it's something that all investors, regardless of their experience or expertise, can learn from.
Now, before we wrap up this part of our deep dive, Let's touch on preferred stocks.
Okay.
Buffett has had both successes and failures with these,
He has.
highlighting the importance of carefully analyzing the underlying business
Right.
and understanding the risks specific to these types of securities.
Absolutely.
He has one of his most successful preferred stock investments was with Wells Fargo,
Yes.
but he also experienced a notable setback with U.S. Air.
Right.
He even awarded himself a silver medal
A silver medal.
for that particular bad investment decision.
A silver medal for a bad decision.
Yes. It's a testament to his humility and willingness to learn from his mistakes.
I love that.
He doesn't shy away from admitting when he's wrong,
Mhm.
and he uses those experiences to improve his decision-making process.
Yeah.
That's a quality I admire in anyone,
It is.
but especially in someone as successful as Buffett.
Yeah.
It's a reminder that we're all human, and we all make mistakes.
You do.
What matters is how we learn from them and move forward.
Exactly. It's those lessons learned often through our mistakes
Yeah.
that ultimately shape us into better investors and better leaders.
Absolutely. All right, we're going to take a quick break, and when we come back, we'll continue our deep dive into the world of Warren Buffett.
Sounds good.
Yeah.
It really is a testament to his humility
Right.
and his willingness to always learn from his mistakes.
Now, with all this talk about finding undervalued companies,
Yeah.
makes me think about another concept Buffett has discussed.
Okay.
Arbitrage.
Right.
Sounds complicated,
Yeah, it can be.
but is it something that, like, the average investor could even attempt?
Well, arbitrage at its core
Okay.
is about exploiting price differences for the same asset in different markets.
So it's kind of like finding a loophole
Yeah.
where you can buy low in one place and sell high in another.
You could think of it that way.
Okay.
It's about capitalizing on inefficiencies in the market.
But isn't that something that requires super fast computers and complex algorithms?
Well,
Like I picture Wall Street traders frantically buying and selling
mhm.
at lightning speed.
There's certainly those high-frequency arbitrage strategies out there,
Right.
but Buffett takes a different approach.
Of course he does. He's not exactly known for being impulsive.
He prefers a more patient, less intense form of arbitrage.
Okay.
He's not chasing those tiny price discrepancies
Right.
that disappear in milliseconds.
So he's not playing the high-speed trading game.
Not at all. He's looking for more substantial opportunities
Okay.
where he can deploy significant capital and earn a good return with relatively low risk.
Can you give me an example of what a Buffett-style arbitrage opportunity might look like?
Sure. One example involves a company called Arata.
Arata. Okay.
In 1988,
Mm-hmm.
Arata agreed to be acquired by Kohlberg, Kravis, Roberts & Co.,
Okay.
or KKR.
KKR, those are some big players in the finance world.
They are?
Weren't they known for those, like, high-stakes leveraged buyouts back in the day?
They were. But the interesting part is the Arata deal
Okay.
was structured in a way that created an opportunity for arbitrageurs.
How so? Was there some kind of catch that most people miss?
The deal included a provision
Okay.
that allowed for a higher payout to shareholders if certain events occurred before the closing date.
Ah, I see. So there was a chance to profit from this uncertainty,
Yes,
depending on how things played out.
precisely. Berkshire bought a substantial amount of Arata stock,
Wow.
betting that those events would occur and they'd receive the higher payout.
Did it work out?
It did,
Okay.
but not without some drama.
I can only imagine how nerve-wracking it must have been
I'm sure.
to wait and see
Yeah.
if those events would actually happen.
The closing was delayed.
Right.
The stock price fluctuated.
Okay.
And for a while, it seemed like the whole deal might fall apart.
Oh, man.
Ugh.
That sounds stressful.
But Buffett and Munger held their ground,
Okay.
and their bet ultimately paid off.
So it came out on top.
Berkshire made a significant profit from the Arata arbitrage play.
Another example of patience and discipline paying off in the long run.
It really is.
Now, shifting gears a bit, I'm curious about Berkshire's approach to selling businesses.
Oh,
We've talked a lot about acquiring them,
mhm.
but they seem reluctant to let go,
Yeah,
even when a business isn't performing at its best.
that's a great observation. It goes back to Buffett's philosophy of building a collection of truly outstanding businesses.
Okay.
He's not interested in churning through investments for quick profits.
So it's about finding those rare gems,
Yes.
holding on to them, letting them compound in value over time.
Exactly. Buffett views Berkshire's subsidiaries as permanent holdings,
Right.
not pieces to be traded or flipped for a quick buck.
It's a very different mindset from what we often see in the investment world, where everything seems to be about short-term gains.
Yeah.
And maximizing returns quarter after quarter.
It's all about the short term these days. It is. And it's one of the reasons for Berkshire's remarkable success. Buffett understands that truly great businesses are hard to find.
Right.
And once you find one, it's often best to hold on tight and let it grow.
It's like that old saying, a bird in the hand is worth two in the bush.
Precisely. But of course, there are exceptions to every rule.
Okay, what are those exceptions?
All right.
When does it make sense for Berkshire to part ways with a business?
Well, Buffett has outlined a few scenarios where selling might be the right move.
Okay.
First, if the business is facing an insurmountable problem.
Okay.
Something that threatens its long-term viability.
So if the business is in a declining industry,
Yeah.
or facing massive technological disruption,
Right.
it might make sense to cut your losses.
Right. Second, if Berkshire needs to raise cash for an exceptionally compelling opportunity.
That makes sense. Sometimes you have to let go of something good to grab onto something even better.
Exactly.
Yeah.
And finally, if the management of the business deteriorates,
Yeah.
if the people running the show are no longer trustworthy or competent,
Right.
it might be time to cut ties.
So it's not just about the numbers.
It's not just about the numbers.
It's also about the people.
It is.
It's about protecting Berkshire's reputation.
Yes.
And its capital.
Exactly. Buffett emphasizes that selling a business is not a decision he takes lightly.
Right.
He carefully weighs the pros and cons and always considers the long-term implications.
Now let's talk about something that often causes a lot of buzz in the stock market.
Okay.
Stock splits.
Stock splits, all right?
I remember when Apple did a stock split a few years ago.
Yeah.
Everyone was talking about it.
They're exciting.
They are.
So stock splits are essentially when a company divides its existing shares into multiple shares.
Okay, so if a company does a 2-for-1 stock split and you own 100 shares,
Right.
you suddenly have 200 shares.
That's right.
It's like magic.
It's not quite magic. The total value of your holdings remains the same,
Okay.
but each share represents a smaller ownership stake.
It's kind of like slicing a pizza into more pieces.
Yeah.
You still have the same amount of pizza, just smaller slices.
That's a great analogy.
So why do companies bother with stock splits?
Wow.
Is it to make the stock more affordable for individual investors?
That's one reason.
Like, I remember thinking it was a good time to buy Apple after the split.
Yeah.
Because the price per share seemed lower.
Companies sometimes split their stock to make it seem more accessible to a wider range of investors.
Right.
A lower price per share can have a psychological effect,
Right.
making the stock feel more attainable.
But it doesn't actually change the value of the company, right?
No, it doesn't. It's a cosmetic change,
Okay.
not a fundamental one.
Interesting. Are there other reasons companies might choose to do a stock split?
Sometimes it's about increasing liquidity.
Okay.
More shares outstanding can mean more trading volume,
Right.
which can make it easier for investors to buy and sell the stock.
So it's about making the stock more attractive to investors.
In a way, yeah.
And potentially boosting demand.
But Buffett doesn't place much emphasis on stock splits.
Okay.
He believes that if a company is truly valuable, the market will recognize that value regardless of the stock price or the number of shares outstanding.
He's not swayed by those cosmetic changes.
Yeah.
He's focused on the underlying fundamentals of the business.
Exactly. Now let's talk about a less common,
Okay.
but potentially more impactful event. Shareholder recapitalizations.
Recapitalizations? That sounds like a pretty drastic move.
They can be. Recapitalizations are major financial restructuring events that can significantly alter a company's capital structure.
So we're talking about big changes here.
Yes.
Not just minor tweaks.
Right. Recapitalizations can involve a variety of actions,
Okay.
such as issuing new debt, repurchasing shares, or even paying out a special dividend.
It sounds like a way for companies to shake things up
Yeah.
and potentially unlock value.
That's often the goal.
No.
Buffett approaches recapitalizations with caution.
Why is that? Wouldn't a move that potentially unlocks value be a good thing?
While recapitalizations can be beneficial,
Yeah.
they can also be driven by short-term thinking,
Mm.
used to mask deeper problems within a company.
So he's wary of those quick fixes that
They-
might not address the root causes
Oh.
of a company's challenges.
Exactly. Buffett emphasizes the importance of understanding the rationale behind a recapitalization
Okay.
and analyzing whether it truly aligns with the long-term interests of the shareholders.
It's about looking beyond the surface,
Yeah.
understanding the motivations
Yep.
behind these complex financial maneuvers.
Precisely. Buffett always encourages independent thinking and a healthy dose of skepticism when it comes to evaluating these types of corporate actions.
That's sound advice. Now, speaking of skepticism,
Okay.
Buffett has a knack for sniffing out accounting shenanigans.
Oh, he does.
Those clever tricks companies sometimes use to make their financials look better than they actually are.
He's a master at unmasking those manipulations. One of his key areas of focus is the difference between accounting goodwill and economic goodwill.
Right, because a company can look great on paper with a lot of accounting goodwill from acquisitions.
Yeah.
But if that doesn't translate into real economic goodwill, brand value, customer loyalty, that sort of thing,
Right.
it's all smoke and mirrors.
Exactly. And this ties into Buffett's concept of owner earnings,
Yep.
which is a way of getting a clearer picture of a company's true profitability.
All right, break that down for me. What are owner earnings?
Okay.
And how do they differ from traditional earnings reported in financial statements?
Think of it this way. Traditional GAAP earnings can be manipulated through various accounting techniques,
Right.
but owner earnings focus on the cash flow that the owner of a business can actually pocket.
So it's about stripping away the accounting gimmicks.
Yeah.
Getting to the heart of how much cash the business is actually generating.
Precisely. It's a more realistic measure of a company's true earning power.
It sounds like a powerful tool for investors
It is.
who want to see through the hype
Right.
and understand the real story behind the numbers.
It highlights Buffett's focus on substance over style.
Right.
He's not impressed by fancy accounting tricks or short-term earning spikes.
Okay.
He's looking for businesses that generate real cash flow over the long term.
And this brings to mind another one of his insightful analogies. In the long run, the market is a weighing machine.
Powerful quote. It's a powerful reminder that eventually the market will accurately assess a company's true worth.
Yeah.
The manipulations, the hype, the short-term fluctuations, they all fade away in the end. What matters is the actual value the business is creating.
It's a reassuring thought for those of us who believe in the power of long-term investing.
It is. It suggests that if you focus on finding those undervalued companies with strong fundamentals and a sustainable competitive advantage, patience will ultimately be rewarded.
Okay, let's shift our focus to corporate governance, specifically the role of the board of directors. Buffett has some strong opinions about the importance of having a well-functioning board, doesn't he?
He does. He sees the board as a crucial safeguard against managerial excess and a driving force for long-term value creation.
But as we discussed earlier, not all boards are created equal.
That's true.
What are some of the red flags that investors should be aware of when evaluating a company's board?
Buffett highlights 3 common board situations that can lead to problems,
Okay.
particularly when it comes to mergers and acquisitions.
All right.
The first is a board that acts as a rubber stamp for the CEO,
Okay.
offering no real challenge or oversight.
So basically, the CEO gets to do whatever they want without any accountability.
Pretty much.
Yeah.
The second red flag is a situation where the CEO is also the controlling shareholder,
Okay.
giving them immense power to push through any deal,
Yeah.
regardless of whether it's in the best interests of the other shareholders.
That definitely sounds like a conflict of interest waiting to happen.
It often does. And finally, you have boards that are composed of well-intentioned but inexperienced directors.
Right.
They might lack the financial savvy or the courage to stand up to a persuasive CEO.
So it's not enough to just have a board.
No.
It's about having a board that's independent,
Right.
experienced,
Yes.
and willing to challenge the CEO when necessary.
Absolutely.
Buffett believes that a strong board is essential for good corporate governance and for protecting the interests of all shareholders.
Now, when it comes to protecting shareholders, Buffett has some interesting views on executive compensation,
He does.
especially when it comes to stock options.
Yeah.
He's not exactly a fan of the way they're often structured, is he?
He's skeptical of how stock options can sometimes create perverse incentives,
Right.
encouraging executives to prioritize short-term stock price gains over long-term value creation.
So he sees them as potentially harmful to the company and his shareholders in the long run.
He does, particularly when they're not designed and implemented thoughtfully.
Buffett believes that executive compensation should be aligned with the long-term interests of the company and its owners.
So it's about rewarding executives for creating real sustainable value,
Yes.
not just for pumping up the stock price temporarily.
Precisely.
Yeah.
And Buffett walks the walk. At Berkshire Hathaway, executive compensation is relatively modest.
Right?
And there's a strong emphasis on long-term performance.
It's a refreshing contrast to the often exorbitant pay packages we see in other companies.
It is. And it speaks to Buffett's commitment to fairness and to creating a culture where everyone benefits from the company's success.
Before we move on to the final part of our deep dive,
Okay.
I want to touch on a topic that often gets overlooked,
Right.
the importance of a company's culture.
Ah, yes, culture. Very important.
Buffett has said that he looks for businesses with a strong culture.
He does.
But what does that actually mean?
It's about more than just having a ping pong table in the break room or offering free snacks.
Right.
It's about having a shared set of values,
Yep.
a clear sense of purpose, and a deep commitment to ethical behavior.
So it's about creating an environment where
Yeah.
people feel valued,
Value.
motivated, and aligned with the company's mission.
Exactly.
Right.
Buffett believes that a strong culture is a competitive advantage, something that can't easily be replicated by competitors.
It makes sense. When people feel good about where they work and what they're doing,
Yeah.
they're more likely to be productive, innovative, and loyal.
Precisely.
Yeah.
And that can translate into better financial performance
Right.
and a stronger, more resilient business.
It's a reminder that the soft stuff,
Yes.
those intangible aspects of a business, can
Mhm.
be just as important as the hard numbers.
Absolutely. And Buffett's track record is proof that focusing on culture, values, and long-term thinking
Right.
can lead to extraordinary results.
Yeah, it really is amazing how Buffett weaves together these seemingly disparate ideas,
Yeah.
financial analysis, corporate governance, company culture,
Mm-hmm.
into a cohesive philosophy for success.
He sees them all as interconnected pieces of the puzzle. You can't achieve long-term success without a solid foundation in each of those areas.
It makes you realize that investing is about so much more than just picking stocks.
It is.
It's about understanding businesses,
Right?
people, and the dynamics of the market.
Exactly.
Yeah.
It's about thinking like an owner,
Yeah.
not just a speculator.
Now, we've talked about Buffett's successes, but he's also been open about his mistakes.
Oh, absolutely.
He even awarded himself a silver medal for a particularly bad investment in U.S. Air.
Yeah, he doesn't shy away from admitting when he's wrong.
Right.
In fact, he embraces those mistakes as learning opportunities.
That's such a refreshing perspective.
It is.
In a world where everyone seems obsessed with projecting an image of perfection,
Right.
Buffett's willingness to acknowledge his flaws is inspiring.
It's a reminder that we're all human and we all make mistakes.
Right.
What matters is that we learn from them and become better investors as a result.
So as we wrap up our deep dive into the mind of Warren Buffett, what are the key takeaways that our listeners should remember?
Well, I think the overarching theme is the importance of long-term thinking, patience, and discipline.
Mm-hmm.
Buffett isn't interested in get-rich-quick schemes or chasing the latest fads.
Right.
He's focused on building sustainable value over decades.
He's like the tortoise and the hare fable.
Exactly.
Slow and steady wins the race.
Slow and steady, that's the key.
And it's about focusing on the fundamentals,
Yes.
understanding the businesses you invest in, analyzing their financials,
Mm-hmm.
assessing their competitive advantages, and evaluating their management teams.
So it's all about those fundamentals.
Don't get swept up in the hype or the short-term noise of the market.
Nope.
Focus on the things that truly matter. The intrinsic value of a business, the quality of its leadership, the strength of its culture.
All those important factors.
And remember that price is what you pay. Value is what you get.
A classic Buffettism.
Don't be afraid to pay a fair price for a wonderful business.
That's right.
So often we get caught up in trying to find bargains.
Yeah.
But as Buffett has shown, it's better to own a piece of a great business,
Mm-hmm.
even if you have to pay a little more for it.
Absolutely. And finally, never stop learning.
That's right.
The market is constantly evolving, and as investors, we need to adapt and grow along with it.
Yeah.
Read books, attend conferences, talk to other investors, and never be afraid to challenge your own assumptions.
That's great advice. Warren Buffett is a lifelong learner,
He is.
and his success is a testament to the power of continuous improvement.
He's constantly seeking new knowledge and refining his investment approach.
Right.
And that's something we can all aspire to.
Well, this has been an incredible journey into the world of Warren Buffett. I feel like I've gained a whole new understanding of his investment philosophy.
Me too.
And the principles that have guided his extraordinary success.
Yeah, it's always inspiring to delve into the mind of one of the greatest investors of all time.
So thanks for joining me on this deep dive into the Essays of Warren Buffett. I hope our listeners found it insightful, and I hope they walk away with the renewed appreciation for the power of long-term thinking, value investing, and staying true to your principles. And as always, we encourage you to keep learning, keep exploring, and keep investing in your own knowledge and growth.
Couldn't have said it better myself.
Yeah.